Okay, so here we are, 10 o'clock. So I'm going to say hello to everybody. And today is a little different. So today we've got a special guest. So we won't be following our normal format. We'll be really, this is the entire broadcast today, whether it's on our podcast or whether it's on YouTube, will be our financial focus. And today's financial focus is going to be investments and the markets. So if you are listening to the podcast, the Not a Guru podcast, I don't know, we're probably into about 2 months of that now. We're going to be referring to some charts and graphs, and you may want to come check out the YouTube channel so you can see those charts and graphs. And as always, if you haven't already, hit the like, subscribe, and notification buttons in your YouTube channel so that you're always notified right away when we have new videos, because we do this live and then we'll repackage it and make any edits and things like that, and then it'll be a recording that I'll send out to you if you're on my email list, and it'll live on YouTube. So if you just want to subscribe, you'll get that notification when the recording comes out. You can listen to it, you can watch it when you like, listen to it on the podcast, what have you. As I said, today is our special guest is Thomas Balis, and he's a chartered financial advisor. And I'm going to talk more about how we work with his firm, Cornerstone Portfolio Research, and how we work together with Attleboro Wealth Management. We're going to talk about some things about what's happening in the markets, different investment strategies. We're not going to talk about specific investments. We're not going to talk about any particular exchange traded fund or mutual fund, because this is a general broadcast. You've heard me say that you should use these things that you learn on YouTube or podcasts or what as education, not as advice. It's really important that you get your advice from the team that's helping you with your individual needs, goals, and issues, not like a Dave Ramsey or anybody, even myself. Don't take this as advice. Take it as education. We've got some big things ahead of us. Presidential election. We've got, we're maybe on the cusp of continuing cuts in interest rates. So we have a lot of questions. And you can ask questions in the chat bar if you'd like to. We'll get to what we can. So Jerry said good morning. David L said good morning. Emily is with us. Thomas. So Emily said, good morning. Looking forward to hearing from you both. And you can't see the YouTube screen, I don't think, right,
No, I
Thomas?
can't.
Yeah.
But
So I'll
it's
just,
good to know there are folks out there listening.
yeah. I'll just play producer there and let you know what's going on. So I want to remind everybody, all your listeners, of our goals. So the goals of this broadcast for us is to have you be inspired to make changes. We do things a little differently, sometimes very, very differently, but we want you to be inspired to make changes. We want you to open your mind to different ideas and different ways of thinking about planning and investing. We want you to stay educated so that you feel confident in your strategies and your plan that you put into place, and we want you to stay updated so you can make adjustments along the way. So that's really it. This is about education. We want you to be updated, inspired, stay educated, and make changes, right? Because we're taught certain things about investing, and we're taught certain things about planning, and unfortunately, most of those things are outdated or wrong. So we want you to stay on track. Okay. So Thomas, let me, since we're past the intro now, let me introduce Thomas Balis. So Thomas founded Cornerstone Portfolio Research in 2020 with 20 plus years of experience in the investment and financial service industry. Investment management is truly his passion. Helping advisors and their clients achieve their goals and dreams is his motivation for getting out of bed every day and his way of making the world a better place. Thomas holds a Bachelor of Science in Business from Ohio State and has since earned the Chartered Financial Analyst, that's CFA designation, as well as the Accredited Portfolio Management Advisor, APMA, and Chartered Mutual Fund Counselor, CMFC certifications. Thomas spent a decade helping investment reps grow their books at JP Morgan Chase and is a former member of the RIA Executive Advisory Council for PIMCO. He is also a member of the CFA Institute and CFA Society of Philadelphia. So we here think of Thomas as our Chief Investment Officer. And really his whole team. So there's another fella, Scott Benton, and Thomas's brother, Arthur, is part of the team as well. And Arthur is an analyst and a trader. So I'll just share with you quickly how this synergy really came about. And it really is a very good synergy. I'll refer to it as that. And at the end of 2022, we had some great success in managing a falling bond market. And that simply was in about February of that year, I liquidated the majority of the bond holdings in our client portfolios, and now we're sitting in cash. And I knew that I needed some additional level of expertise as we're getting back into the markets at the end of 2022, going into 2023. So the uncommon tactical move that I made to pull people out of the bond market was, or we made, was, like I said, was very fortunate. Again, uncommon, but I recognized I needed some help, and I interviewed several firms, and we ended up hiring Cornerstone Portfolio Management. And Cornerstone, although they're not, we don't, they're not W-2 employees, but they are team members. There's no doubt about that. And the difference about the way we do things and how many financial advisors and financial advisory firms handle their investments is we manage them all, our investments in-house. We don't ship our funds to Cornerstone or Vanguard or anybody else and say we're going to watch them from afar. We watch them closely in-house with the help of some of the experts at Cornerstone Portfolio Research with a combined 70 years plus experience. So it's really been a great synergy. I want to thank you for that, Thomas. And Thomas has put together some great material for us to review from different sources. We were going over it before our broadcast today, and I'm excited about this. So, Thomas, with that, anything you want to say before we get started?
Now we're so thrilled with our partnership with the team at Attleboro Wealth Management, and our our vision really is to help advisors help their clients achieve their goals and dreams. And we think nobody knows a client better than the advisor that works directly with them. And so our goal, as we've worked with Mark over the last couple of years, is to partner with him to design custom investment programs designed, with strategy to align with, how he's created the firm. And, it's been a wonderful thing for our team. And, both Scott and Arthur and as well as myself have really enjoyed getting to know the team at Attleboro, and as well as many of the clients at some of the events. And so we're thrilled to be part of today's webcast.
Thank you. Thank you. All right. Well, let's kick it off, Thomas. So I know you want to. Do you want to start with your slides, or is that where you want to go with that?
Yeah. Well, I know there's really three kind of big topics that I want to cover today. I thought we would start with kind of the Federal Reserve. They met a couple of weeks ago, and so I thought we would talk about kind of some of what's going on with them. I thought we could talk about elections that are coming up here.
Yes.
And then I thought we could, spend some time on kind of markets and a review of where markets have been and kind of where we see the markets going in the coming months and quarters. And so, if the listeners have paid much attention to financial news, they saw the announcement from the Federal Reserve about a change in interest rate policy. But for folks that don't watch the financial news super closely, I thought it would make sense for us just to kind of recap what happened. Let's maybe start there if we could do that. And
I think it's great.
I do have some slides that I'll kind of share onto the screen. And again, for our listeners, I'll try to describe some of the numbers on them. But for folks that are viewing, I'll try and direct you to some important updates, because I think seeing it on the screen can help our discussion. So the Federal Reserve cut rates at their most recent meeting by 0.5%. And I think it's important before we even go into the cut to maybe just even step back for a moment and remind folks of the backdrop of how we got here, okay? And why the Fed is choosing to cut interest rates. So we have to kind of rewind the tape, 3.5 years. So COVID, right? I guess it was 4 years ago. I shouldn't say 4 years ago. So 4 years ago, COVID hits, and we have this massive self-inflicted economic slowdown that we engaged in across the globe that really put unemployment surged, economic growth slowed, and so global central banks around the world decreased interest rates to nothing to stimulate the economy and to support all of the economies and help avoid a global depression, if you will. And so interest rates went to zero. And then we also had a massive amount of economic stimulus that came in the form of fiscal stimulus, a lot of government spending to prop up the economy. And so what we saw as an outgrowth of that was an uptick in inflation. And inflation at first, the Fed thought was what they called transitory. They just thought, oh, it's here for a little bit, but it won't be here long. And that's a call that they got wrong.
Mhm.
And inflation became stickier and stickier and a more significant factor in all of our lives. And the Fed's primary tool to fight that is with interest rates. And so they raised interest rates, and they raised them above what's considered the neutral rate, in effect putting their foot on the brake of the economy. So they had, put a lot of stimulus. The government had put a lot of stimulus out there. Economic growth was really, really high. And so that caused prices to go up, and therefore, inflation was high, and they needed to get that slowed down. And so they took interest rates above where they had been in recent decades, all the way up to a range of 5.25% to 5.5%. And we've watched inflation slowly come down, and I've got some slides that'll speak to that in a bit. But it's important to understand the backdrop of why were they cutting interest rates? Because historically, what we've seen is the last few cutting cycles, the Federal Reserve has cut interest rates in response to something breaking.
Mhm.
Okay, we think about COVID and the economy, that the self-inflicted shutdown of the economy as a result of that, and they had to drop interest rates. And before that, it was the global financial crisis, right? They had to
Mhm.
cut interest rates because of the massive economic slowdown that came as a result of the housing crisis, and even the dot-com bubble bursting in the early 2000s. And so things broke in the economy and markets, and the Federal Reserve had to decrease interest rates to stimulate the economy. That's
Mhm.
actually not what's happened here, right? Nothing has broken yet. Um, and we'll talk about the yet part later on at the end of the call. But the Fed cut interest rates as a way of taking their foot somewhat off of the brake. Now it's still on the brake because the Federal Reserve has a target of what they consider neutral interest rates that is around 2.5% to 3%, somewhere in there. I mean, economists differ on what neutral interest rates should be, where they're not stimulating the economy and where they're not, slowing the economy down. But they took the rate from 5.25% to 5.5%. That was the range before, and they lowered it by half a percentage. So now the interest rate that the Federal Reserve sets is 4.75 to 5%. And that is the short-term rate, the overnight interest rate that banks can lend to one another. It's not necessarily the rates that are on your car loan or your mortgage or those kinds of things. The Federal Reserve doesn't necessarily control those directly. They control very short-term interest rates. And so they decreased rates to 4.75% to 5%. And I'm going to share this summary of economic projections because they release some projections every other meeting. Let me just see if I can get this shared appropriately. And I think it's worth just taking a look at a few of those and getting that
Yes.
that that data straight from the horse's mouth. All right. So hopefully you're seeing a screen here, and I've blown this up just a little bit. This is a table, and this is directly released from the Federal Reserve Board members, and it shows the changes in their projections. And there's a lot of numbers on here. So I want to do my best to kind of point to the pertinent ones. And so you see here in this first column. And we'll kind of work from the bottom up. So you can see here the federal funds interest rate is now being projected by the end of 2024 to be at 4.4%. That's rounding. So that means a range of 4.25 to 4.5. So that's about another 0.5% lower than it is even right now. So they've already lowered it 0.5%. And they're saying that as of the September release, if they were making their best estimate on where they see the appropriate direction of interest rate policy by the end of the year, that will be another 0.5% lower. And if you notice, they give you in comparison to what they said last time. So what
Yep.
they said in June was that they thought rates would be between 5 to 5.25. And so they've moved that number significantly down. And the reason they moved that number is, as in Chair Powell's words, and I'll just read from them, that in light of progress on inflation and the balance of risks. And so, as you can see here, they had previously been forecasting inflation, their preferred measure, what's called core PCE inflation.
Yes.
And it had been forecasted to be at 2.8% by the end of the year. They're now forecasting core to be at 2.6. They're forecasting headline to be 2.3. So getting closer and closer to that 2% target that they have, because the Fed has two mandates: price stability and full employment. And then you can see here the unemployment numbers have actually.
Can I interrupt you for a second, Thomas?
Of course, let's do it.
Could
Yeah.
you just take a second to explain the difference for the audience between headline and core inflation?
Yeah, so headline inflation includes some of the what would be considered more volatile parts of inflation. So think about energy costs, for example. Those can bounce around pretty significantly. And so the core numbers you can see down here toward the bottom exclude food and energy. Those can jump around a little bit. So they look at the core number because it's a little bit more stable. So we all saw a couple of years ago where inflation numbers really spiked, and a lot of that was gas prices, right?
Yep.
And so they look at both sets of numbers.
Right. Okay. Thank you for that.
Yep. You can see unemployment, their projection ticking up from 4% to 4.4%. And then they're forecasting end of year gross domestic product at 2%, which is kind of their long-term target. You can see here, longer term, they think it'll be 1.8.
And the Fed sees that increase of unemployment as a positive, right? For when we're talking about, right? Is that correct?
Yeah, absolutely. And we'll take a look at a couple of more slides here in a little bit, but yes. So the Fed's goal is to have stable employment or full employment, right? And economists differ on what employment rate actually means full employment, because there's a certain amount of churn within the job market as folks leave one job, they go to another job, jobs are eliminated, jobs are created, and so there's a certain amount of movement in between. And historically, you would have considered unemployment with 4 point anything with it to be a pretty good number. And then in recent years that we saw that number get down to 3.5 or even the upper 3%. Yeah. And most economists would say that number is not a sustainable number, that we were almost over full employment at that point, where there wasn't as much turnover in the labor market as would be considered normal, and that led to actually some wage inflation. So going from 4 to 4.5, look, nobody ever wants to see someone lose a job, and we're not saying that the Fed wants people to lose jobs by any means, but they do want to achieve a normal sense of job turnover within the economy, and certainly going from 4 to 4.4 is definitely still considered well within what would be considered a full employment range.
Well, I think one of the criticisms of the Fed has been that they maybe have acted too slowly in cutting rates. But when just to defend them a little bit, when the economy and the markets have been just outperforming expectations, I'll say, like they have been, and then you throw a rate cut in the middle of that, I think it does increase the risk of higher inflation and wage inflation, which you can. I understand why the Fed excludes food and energy for their core number, but they're two of the areas that affect consumers the most, right? So,
well, for sure, and the challenge there too, Mark, is that it's really easy for us to get confused about the difference between inflation and absolute prices, right? Like, when my wife comes home with the receipt from the grocery store, it doesn't feel like inflation is 2%.
Right. Exactly. Yeah.
And that's because the absolute prices of, things like food and things that we buy at the grocery store went up significantly. We had those years of higher inflation, and we don't, prices, for inflation, even if inflation goes to zero, that doesn't mean prices decrease. It just means
Right.
that they stop increasing, right? And so, it's important to recognize that because, I look at this and say, well, okay, inflation's at 2 point something percent. Boy, there's some parts of it that it just doesn't feel that way. And I've
That's
got
right.
another slide here that kind of breaks down inflation. And again, this slide it's pretty busy. It's got a lot of colors on it. But you can see here, this goes back to 2021, and it shows the rise of inflation. And so you see back in early 21, it was at 1.7%. And this is CPI inflation, the Consumer Price Index.
Yep.
So this is a slightly different measure, but one that a lot of folks also use. And it's based on the price of a basket of goods. And so you can see here that this headline number, so this includes food and energy, goes from 1.7, 2.6% in early 2021. It rises through the 5% range, up through the 6% range. And by the summer of 2022, got all the way up to 9.1%. And you can see there were some, the biggest chunks of that, this light green on the chart is energy.
Mhm.
So you saw food prices start to rise in this purple, it's called food at home as opposed to food in restaurants. You saw the light blue here, dining, recreation, other services. So people eating out, so you see here how that expanded through the first couple of years of COVID. And then once we got past the peak in 2022, the numbers started to come down. And we said even then, Mark, that the journey from 8% to 4% would be a lot quicker than the journey from 4% to 2%.
You
And
did. I
that
remember that. Yeah. Mhm.
absolutely came true.
Mhm.
We see here that inflation started to come down as the Fed increased interest rates and put that foot on the brake of demand. And so we saw rates start to come down, especially on the energy side of things. But you can see here at the bottom, this dark blue, housing costs, shelter costs continued to rise. And shelter costs act with a lag, especially within the CPI, because it's based upon a concept that's called owner's equivalent rent. And basically it's, they look at a house and say, if somebody owned this house, how much would it cost them to rent that? And so, there's a complexity that goes into those calculations that, has a real lag impact to inflation. And that's why inflation remained, somewhat, sticky and troublesome there, even through 2023. You can see here, once we got down to 3.7 to threes, we hung out there for a while
Yeah.
and just bumped down into the twos. And a lot of that, as you can see, is this dark blue, this shelter component. And so, year over year prices have started to slow. And the reason that the Fed has been so has waited until now to take their foot off of the brake, if you will, to start decreasing interest rates, is because there was concern about inflation reigniting. That if they took their foot off of the brake, that prices could go back up, and that inflation is really bad, especially is for everybody, but especially for those at the
Mhm.
lower end of the economic spectrum.
Yes. Yes.
Um,
Absolutely.
and so they didn't want to see that reignite the way that it did back in the 70s. And so there's been a lot of progress on inflation. I know for most of us, it doesn't feel that way. When we pay our car insurance bill, you
Holy
see that
cow. Yeah.
in
Yeah.
the red, or when we pay for the groceries, because the absolute price has gone up and it probably won't go back down.
Yeah.
Uh, but the rate of increase has slowed.
Right. Yeah. That's a great chart. That's a great chart. I like the way that spells that. I don't believe the section about auto insurance, but but I'll accept it.
Yeah. 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 Car insurance has definitely gotten more expensive
Oh,
recently.
auto home. God forbid if you're in a coastal town, it's really challenging for people.
Yep.
Yeah.
Well, and there's so much technology that goes into these cars now anymore. You know, my daughter had a little mishap with the side mirror on her car, and it seems like just yesterday I could have gone to the junkyard or the parts store and spent $100 on a mirror or something and fixed it. And now they have cameras and
Yeah,
sensors and all these other things into them and it makes the cost of repairing cars much more expensive, which of course has driven insurance rates up.
that's right.
So the other thing that, in addition to seeing progress on the inflation front, is that the Fed also started to notice some what they would call normalization in the job market. And you can see here on this next chart, this top gray line is the unemployment rate. And you can see here in April of 2020, it spiked as high as 14.8%. And then has come back sharply down in response to stimulus. And now here very recently on the right-hand side of the chart has started to come back up. And the blue line that you see on here is wage growth. And so you saw a pretty stark, jump here in wage growth. And one of the concerns that the Fed had was that they didn't want to get into a wage price spiral, where companies are having to pay higher wages, and so they increase their prices, and then workers start demanding higher wages because they can't afford the prices that have gone up, and so it turns into this spiral. And the Fed really wanted to be mindful of that. And so you can see here in July of 2024, the wage growth number has come down to 3.8%, which is in line with this kind of long-term average if you look at this blue dotted line.
Yeah.
So, wage growth has slowed down. Unemployment has ticked back up. You can see here the 50-year average for unemployment is 6%.
Yeah. Wow.
So even at 4.3, it's still, well below the long-term average, and certainly a number that most economists would consider consistent with full employment.
Yeah. Yeah, those long-term numbers really put it in perspective. I think I remember reading that the 100-year average for inflation was 3.5%, right? Right around there. So when you think about where we are even today, and certainly where we've been for most of the last decade and a half, it's been well below that average.
Yep, for sure. For sure. And then, the other thing that the Fed always keeps an eye on, of course, is the economy and economic growth. And you can see here, kind of since the beginning of, since 2000, you can see the long-term trend of economic growth here, this light blue line on the chart is around 2.1%. And if we take a look at the most recent data releases, the second quarter of 2024, year-over-year economic growth is at 3.1%. So we're growing above trend. The Federal Reserve thinks that the long-term kind of neutral GDP growth is likely to be around 1.8%. So currently, if you take a look at year-over-year results for the last 4 quarters, the economy is doing well. And this chart on the right just shows kind of where a lot of that is driven. So over 2/3, 67.7%, is driven by consumption, so consumer spending. The consumer powers the US economy. And so, as the consumer feels healthy and has the ability to spend money, that creates economic growth. And so you can see here, beyond that, the next biggest contributor is government spending, 17%. And we'll talk a little bit about that when we get to the section on elections. And so,
Okay.
but
That's
economic
excellent.
growth is very solid. And then finally, at federal interest rate funds projections. So you can see here again, this chart's a little busy. This chart shows you the history of Federal Reserve interest rates. And you can see, it was at 5.38%. That was as of the June forecasts. And, they had forecasted coming down here to 5.1, 4.1, 3.1. And as we saw on their own projection, we'll take a look at something called the dot plot. And you can see here that the central tendency right here, these are the dots that you hear about on the financial news. Each dot represents the forecast of a Federal Reserve voting member. And you can see here, they all kind of circulate by the end of the year to being between 4.25 and 4.5. So that's why they forecast 4.4. Then they forecast them coming down another full percent down here between 3.25 to 3.4 by the end of 2025. And then as you can see, as we get farther out into farther years, they kind of spread out a little bit more as there's less certainty and a broader range of opinions on where rates will be by 2026. But then you can see here for the longer run, that 2.5 to 3% range is where most of the Federal Reserve see longer term interest rates ending up. And so,
let me ask you a question there because I never considered this before when I looked at the dot plots, but are these anonymous? Are these, can we identify who the dots are or
no, you
is this,
cannot.
yeah,
No,
okay.
no, I'm sure that they're known to each other within the Federal Reserve, but no, they don't publish individual projections like that.
Because it'd be interesting to see who the outliers are and where they're located, right?
Well, and some of those comments are made publicly. I mean, some
Yeah, yes, I've seen that.
Federal Reserve presidents will come out and make independent, opinions,
Mhm.
and publicly state that, but they don't provide that, member by member data, at least within the summary of economic projections.
Yeah,
So you
interesting.
can see here, they anticipate, again, Fed fund rates are down 0.5% to come down another 0.5% before the end of the year, to come down another percent after that, to come down 0.5% in 2026, and then longer term to kind of hang out there in the upper twos. It looks like 2.75 to 3% is where they estimate that to be. So just to wrap up on Federal Reserve policy, again, this isn't your mortgage rate. This isn't your car loan rate. This isn't your credit card rate. This is the overnight rate. The short-term interest rate has the biggest impact on things like money market funds and very short-term bond funds. And then it has an indirect impact on longer-term interest rates.
Mhm.
So any questions on that before we move on to the elections, Mark?
Now, and I'm really glad you mentioned the impact on short-term bond funds and money market funds because just like we get lulled into a sense of complacency when it came to um, interest rates, lower interest rates, and lower inflation. Well, I do hear people getting lulled into, well, I can get 5% in the money market. I can get 4% in or 5% in a CD. Those days are coming to an end. So one of the I don't know when, right? It's going to start happening very, very soon. But one of the conversations we had, just for the people listening, as an investment committee, maybe a month ago or so now, is I said, okay, we're going to start seeing a reduction in interest rates that we'll get on these short-term money markets and short-term bonds. So we're going to have to look for alternatives for our nearest segment one portfolio. If we have time, I'll explain the segmentation strategy a little bit. But so that party's coming to an end soon. These very easy high interest rates. If you don't think 5% on the money market is high, you should recheck your thoughts on that because it is a high rate and it's not that easy to achieve a 5% risk-free return over a long period of time. But
Well,
that was a great point.
yeah, and it's important for our viewers to understand too that the difference between short-term rates and different, like say intermediate term rates. I mean, a lot of
Yeah.
folks see in the financial news, they see like the 10-year treasury rate, for
Mhm.
example, and yields on the 10-year treasury. And it might surprise some listeners that, before the Federal Reserve policy meeting, the 10-year was trading at around 3.6%, or a little, right around there. And even though the Federal Reserve decreased rates by 0.5%, the 10-year actually has gone up since the meeting. The
Yeah.
10-year interest rate has gone up to 3.7, 3.75
Mhm.
ish,
Yeah.
somewhere in there. And so, and that's because the bond market is what controls those longer end rates. And so, the market participants often try and anticipate what they think will happen. And so, as the price of bonds had gone up and up and up, the yield on bonds had gone down. And so, folks had bought a lot of intermediate, term bonds, if you will, anticipation of the Fed cutting rates. And then they took profits. And when they sold off
Mhm.
bonds, the bonds went down in price and the yields went up. And
Mhm.
so the market, tries to price these things in advance. Their markets are forward looking. And
Right.
so, that's why you see a little bit of a difference between, bond returns and different parts of the maturity spectrum versus short-term interest rates.
Yeah. Yeah. Great point.
So let's talk about elections, right?
Everybody wants to know about the election. Everybody's talking.
Elections are coming, and like,
Yeah.
what is this go? What's happening, right?
Yeah.
What's going to happen to the market? What's going to happen to my portfolio? What's just going to
Right.
happen with these elections? I mean, because if you live in Pennsylvania, and I know our audience is global, but a lot of our folks here, a lot of our clients and listeners are here in the U.S. and certainly in the Northeast part of the country. If
Yes.
you live in Pennsylvania, you can't have something go to commercial without getting carpet bombed with political ads.
That's right.
And
That's
this
the truth.
and it's just it's crazy. It really is.
Outrageous ads on both sides.
Yeah,
Outrageous.
yeah. The amount of spending that's going into at least the Pennsylvania TV markets is just beyond belief to me. But so let's talk about the elections, okay? And let's talk about things that are the same and things that are different. And so, and again, we know for many listeners, politics and elections can be sensitive topics. We don't take any side on this. We don't look at any one side or the other as good or bad. We just look at what do we think the likely policy impacts are to the markets. And so there's no value assigned to whether those impacts are good or bad for society. This is all just about what it means for portfolios.
Right.
So you've got both sides talking about more spending. No one's talking about spending less money. You know, whether
True.
whether there's a Republican administration with the Trump campaign, or whether there's a Democratic administration with the Harris campaign, neither side is talking about cutting back on spending. And that's kind of a change from history, right? Like historically, you might have viewed the Republican Party as a party of more fiscal responsibility, or wanting to rein in government spending, and we haven't
Mhm.
seen that as much in recent elections with President Trump's campaign. And so, why do I bring that up? Well, back to that JP Morgan chart that we referenced, right? Government spending impacts the economy. So as the government spends more money, that can have an impact on GDP growth, but can also have an impact on inflation, right?
Mhm.
And
Mhm.
so, one of the reasons, that the Fed is taking its foot off of the brake, and easing up on interest rates, is because inflation numbers have finally kind of, are directionally headed, in the right direction and getting close to that 2% target that they have. And so if the government starts spending even more money, then, that can be inflationary.
Mhm.
Um, so that's one thing that you see that is in common for both campaigns. Both sides are promising tax cuts, right?
Yes.
Maybe tax cuts in different ways,
Yes.
right? But we hear, both campaigns talking about no taxes on tips. I think I heard something about no taxes on overtime. I've heard something from the other side, no tax increases on anybody making less than 400,000, and tax credits for small business. And so both sides are talking about tax cuts. And we know that the 2017 Targeted Jobs and Tax Act tax brackets expire at the end of 2025, absent some kind of congressional change. But both sides are talking about extending those in some way, shape, or form.
Yes. I agree
Maybe
with that.
not in their entirety,
Right.
but again, if you're maintaining those tax cuts, that means more government debt, more government deficits, and
Yes.
recently government spending exceeded, our payments on the interest payments on our debt now exceed our defense budget,
Yes.
now exceed $1 trillion a year. And the um the there's a part of me that my daughter calls the old man in me that says, that wants to say, oh man, this is really bad, and things are terrible. And I think most economists would agree that the current path of spending and debt increase is not sustainable in the long term for our economy. There will be a reckoning at some point,
Mhm.
you know, but unfortunately, well, I shouldn't say unfortunately, fortunately or unfortunately, regardless, that reckoning is not today. The bond market, the global bond market, and the market makers seem to be willing to tolerate that $35 trillion worth of debt for the United States is manageable, despite the fact that it's at a percentage to GDP that's comparable with post World War II.
Yeah.
And so at some point, there will be a reckoning where, investors demand higher interest rates from, the US Treasury in order to finance its debt. And at some point, there will have to be some kind of correction to government policy, but that's not here today.
Now,
Um,
and I say this often. Nobody who listens on a regular basis will be surprised, but Thomas is absolutely right. There's no courage in Washington to look at these. Yeah, he said something. He said that our path is unsustainable, and you can read that directly from the Treasurer's report, a report that's released from our own U.S. Treasury, and they've been saying this for at least the past several years, that our trajectory for our financial outlook is unsustainable given what we're currently doing, and it's completely irresponsible to talk about tax cuts. And I can say this because I am not running for office, but it's completely irresponsible to talk about tax cuts and increased spending when we should be doing the exact opposite for the financial health of our nation. Now, I'm very happy as a planner that I have more time to use the strategies we have to get people into more tax efficient categories with their funds, and that's really important, into the proper buckets, because we can't help everybody, but geez, I want to be able to help as many people as we can, as that freight train is coming. But you're right, Thomas. There will be a day of reckoning, and unfortunately, it will not be the 11th hour, but the 12th hour that we'll see this day of reckoning. And we've seen that. Just wasn't in June we had last debt ceiling issue, and that went right to the very end. And folks, we cannot not extend our debt ceiling. If we can't pay our debts, it is not good at all. It's actually catastrophic for our nation and really the rest of the world. But that is something that should be an area where you think both sides can work together very, very quickly and avoid this from happening. But it goes right to the 12th hour. So I think we're going to 12th hour this one too as a nation. But I'll get off my soapbox and let you continue.
Yes. So there's no doubt that there's a reckoning coming. And
Mhm.
and the challenging part of it is there's not an investment thesis for that right now. I
Mhm.
mean, you can't not be invested in bonds. You can't not be invested in treasuries. Despite the fact that there are longer terms risks and the lack of sustainability I mentioned, bonds are an important part of a portfolio.
Mhm.
And that reckoning will be another day. The other thing that
Yes.
I want to talk about is a little bit in terms of the differences in the campaigns and the impacts that those things might have. And two differences, I think that, I mean, there's plenty of differences, but a couple that I'll highlight. So number one is around tariffs. So we've heard a lot from the Trump administration about, increasing tariffs on imports and, using that as a major revenue source. And again, I won't get into an argument on whether or not tariffs are good or bad. But I will say that broadly speaking, that tariffs are inflationary.
Mhm.
When tariffs are assessed, prices increase. Um, and you can argue about who pays for the increase, whether it's the foreign government or it's the end consumer or some mixture of in between. But the bottom line is that when tariff policy is put in place, prices generally increase, and that's inflationary. And so it could, definitely have a mixed impact, an inflation reignition, if you will, if those tariffs are broad-based. And so that could cause inflation to go up. And the only way for the Fed to fight inflation going up is to raise interest rates again.
Mhm.
And so you've got that potential impact in the event of a Republican administration, if in fact they follow through on those tariffs.
Yeah.
On the Democratic side, we've heard a lot about of noise around you know, potential taxes on unrealized gains. And, you know, you can, there's a lot of folks that might argue about the constitutionality of that or whether it's even doable and different attempts to do that globally and how that's gone sideways. But regardless of whether it's taxes on unrealized gains, whether it's removing the wage cap on income that's taxed for Social Security purposes, whether it's the billionaire's tax, there's no doubt that that the assumption is that higher taxes for the wealthy, those upper brackets, if you will, are part of a democratic administration, if you will.
Mhm.
So higher taxes there, but also higher spending. And again, both sides are talking about spending more money.
Yeah.
But you hear talk about additional Green New Deal spending, for example. You hear a lot about um, you know the need to spend even more on things like Obamacare, or making health, continuing to drive healthcare prices down. All of those things come at costs. And so, regardless of which side would win, you're going to see different potential impacts to the economy as a result of them. I mean, it's going to happen. And that leads me to, people say, well, okay, well, what is that? What does that mean? Like, what does the market want to see happen? The market likes divided government. Um, the market likes when there's one party in power in the White House and a different mixture of power in Congress. Because when you have, when you have all parts of government in one party, big changes can happen, right? And the market doesn't like big changes. The market likes predictability. And
Mhm.
so when you have a divided government, when you have some Republican control in some parts of it and some Democratic control in other parts of it, it forces compromise and it forces any activity to be centered around the status quo, not big changes. And so the market likes the ability to plan and to think forward, to make
Mhm.
capital investment decisions on a forward-looking basis. Some capital plan investments, are go years and even decades into the making. Think about pipelines, for example.
Yeah.
And so, you've got a market that craves predictability. And so the market likes, mixed government. And I think the consensus forecast from a lot of the talking heads is that some form of mixed government is likely.
Yeah.
Uh, and so the market would like that. But regardless of what kind of government we end up with, I think it's important to think about how that should or shouldn't impact our investing. And so I
So
just,
Thomas, I just want to bring it to your attention that we've got about 10 minutes left. So I just want to make sure you hit all the points you want to hit. So I don't want to slow you down. I just want to,
yeah. So we've got, you've got here, this is a nifty chart that we've got from First Trust, and it shows the growth of the $10,000 in the S&P 500 since 1949. And so you can see here, this blue line along the bottom, if you're looking, is if you had invested $10,000 only when there was a Democratic president,
Mhm.
and then you weren't invested other times. And the red line is if you were only invested during the times there was a Republican president. And you can see both of these lines down here are pretty lackluster. But for the investor that stayed invested, regardless of which party was in power for the White House, you could see here the black line shows by far the biggest results going back in time. And so that principle of not allowing your politics to drive your investment portfolio, we think is absolutely essential, because we know that over the long term, there's going to be ups and downs. And you see that on this earlier slide. There's always a reason to not be invested, right?
Mhm.
There's always something going on, some major event. But you can see here over time, again, from 1970 to 2024, the market is all, up and to the right. Does it have dips and valleys? Absolutely. Do bad things happen? For sure. But does staying invested pay off?
What is that? What are you pointing to in that one side? That chart's a little hard to read. What does that say?
Yeah. Oh, these are just different items that happen, like the
No,
birth.
I thought you were pointing to one in particular about bad
Oh,
things.
no, no, no. I'm sorry. My mouse was just stuck there.
Oh,
So you can
oh, I
see,
see what it was now.
yeah.
Yeah,
So you can
yeah. It's
see
not
whether,
again, not a political statement anywhere.
yeah. So whether Russia's invading the Ukraine, or
Yeah, right, right.
whether it was Trump getting elected, or Osama bin Laden getting killed, or the 9/11, there's definitely global crises that can impact markets, but the markets are resilient over the long term. And
Mhm.
so our counsel to all of our clients is to stick with your plan. Don't allow politics to dictate whether or not you are in or out of the market. Your plan, your goals, your risk tolerance should drive those decisions, not who wins the election in November.
Great point.
And I want to transition then to our final topic, and that's really around kind of market performance and market outlook. Okay.
Sounds great.
I'm going to share a different screen here. Let me go back.
So while Thomas is looking at that or looking for that, so when we talk about staying the course, not letting your politics decide, your investment strategy, your financial plan should decide your investment strategy. So you hear me talking about foundation, setting your foundation. That foundation is really built on that, the three pillars I talk about: asset allocation, principal protection, and account segmentation. And that segmentation strategy we have, while it's very time consuming and it's very laborious, is really, I would even say, is more so the bedrock of our foundation, and allowing for, if your first 3 years of retirement, for example, and your second 3 years of retirement, so your first combined 6 years are in assets, that the investments that can grow slightly, we get smaller returns in those assets potentially, but very, very little risk. Then you can hold out and not have to worry about these significant volatility movements in your investments. And then the ones where we have growth are set for use later in life, or maybe you may never need access to those funds. But and if you don't need something for 8 years, 10 years, and further out, then we can have more volatility there, and that's where we have more stock exposure. And these things help people. First of all, it helps your plan and your retirement funding be more successful, but it also helps you sleep better at night. So we can talk about that, and you can always, I'll drop it in the, so I've got a video on our three pillars of investment management. So I'll drop that in the description, just in case you want to see that.
Yep.
It's like almost in every description now.
So here we have a table, and this from our friends at JP Morgan, just on index returns, not individual investment returns, but index returns. And this was through the 23rd. So this was their release that came out Monday. And so you can see here, whether you look at the S&P 500 or the NASDAQ as a barometer of US returns, markets are up around 20% this year for domestically. International markets this year up around 11. When you blend those things together, global markets are up around 14 to 15% if you look at the All Country World Index, which is not on this page. But overall, markets have had a very positive year, including September. Normally, September is a very volatile month, but markets have set new records this month and are trading near those highs as we stream this right now. And as you can look at different sections of the market, you can see that the bulk of that performance has come from what's called large cap growth, or large US growth stocks. So you may have heard the phrase the Magnificent Seven. So those big mega cap tech names that have been influenced by the popularity and more widespread availability of AI. And so Microsoft, Apple, Alphabet, those Tesla. So there's what's considered the Magnificent Seven. They have made up a large part of investment returns this year. Fortunately, we started to see a bit of a rotation in the month of September where we've seen that start to broaden out to what I call the S&P 493, the other 493 names in the S&P 500, where
Mhm.
we've started to see some of those other names start to come into their own, even as some of the Mag 7 have pulled back. And so you see, markets being up 20% domestically, large cap, small caps, smaller companies, that trade for $2 to $3 billion in valuation, are much more attractively priced. They're up 11% this year, which is not a bad year. Like, right?
Yeah.
If you did an investment in the stock market and it made 11% for the year, most years are pretty happy with that.
Yeah.
Uh, but as you look at that relative to its large cap, it has trailed. And then on the bond front, I think it's important to note that bonds are back and have actually had a good year, especially again this last several months. So you can see here the U.S. Aggregate Index, which is a broad measure of investment grade bonds, is up 4.7% for the year. Corporate bonds are up 5.5.
And Thomas,
Um,
can I interject? We look at the U.S. aggregate bond market index. I want to say that 4.7% is probably almost all in the last few months, right?
oh
It
yeah, for
was,
sure. Yeah, if you
yeah,
looked at it at the beginning of the summer, it was flat.
it was flat or negative any given week. You're right. Yeah.
Yep, for sure. And then as you get farther down onto this table, you see some of those other bond rates that I mentioned. So you can see
Mhm.
here that, for example, a year ago, the 10-year Treasury was at 4.3, and currently, at least as of the 20th, it was at 3.73.
Mhm.
So a pretty big swing in that intermediate range, that middle range of bond maturities, if you will. The thing that I want to draw folks' attentions to are this what's called next 12 months price earnings or forward-looking PE ratios. This is basically the price multiple of what folks are paying for stocks relative to their earnings. And so the S&P 500 is currently trading at 21.3 times the earnings estimate over the next 12 months. And relative to history, it's trading pretty rich. And so, why do I say that? Well, I say that because it's important for us to level set our expectations and to manage our expectations. You know, we've had a phenomenal year of stock returns this year. We
Mhm.
had a phenomenal year last year in
Yeah.
stock returns. But we all know on this call that we don't get phenomenal years every year for stock returns. And in fact, I've got a slide a little here. Here we go. So you can see here, this is just a quilt chart that shows different asset class returns over the last 20 years. And you can see here, this again goes through the end of the quarter, I think, but you can see here different colors are at the top at different times because some years it's US large cap that's doing the best. Some years it's cash. Some years it's real estate. Some years it's small caps. Some years, it's emerging markets. So we never know exactly what's going to be the very best asset class and what's going to be the very worst asset class in any given year, which is why we pursue a broadly diversified asset allocation mix when we design our portfolios, this path across the middle, if you will. But in a year where we've had 26% in US large cap last year, 20% year to date this year so far, it's unlikely for that level to continue. And so what I tell investors is that, look, if you're in a well-diversified, blend of, stocks and bonds that are invested for the long term, the long-term averages you should assume are probably 5-6%. Are you going to have years that are better than that? For sure. Are you going to have years that are worse than that? For sure. But we know that, when we see these years where it's where the market's up 20%, we look at our portfolio and, because we're diversified, maybe our portfolio is up 10%. And we're feeling great about that this year.
Mhm.
We have to remember that those returns aren't sustainable and that there will be dips and that we have to embrace those dips as good things. And that can be a little hard for folks to understand, but I know we're at the end of time here, but as we go into the election and into the end of the year, we would expect continued volatility. You know,
Mhm.
we've seen some ups and downs, and there was a chart here just above where JP Morgan shows the intra-year drops. On average, the market drops 14.2% some point from peak to trough on average throughout the year, and still ends up a lot. Like you can see here on some of
Yeah.
these red numbers, these are like how far the decline was. We've had declines of 20, 25, 34, 5% some years, 28, 19. Our biggest drop this year has been 8%.
Yeah.
So we're still we have had below average market volatility in terms of peak to trough declines so far. So we could very well be in for another drop before the end of the year. With all of the uncertainty around the election, with all of the uncertainty geopolitically between China and Taiwan, between the Middle East, between
That's right.
Russia and the Ukraine. So we say, steady as we go. We want to stay invested because we are long-term investors, but we should expect volatility and we should expect returns to be less rosy going forward. And that's okay because as the market dips, those dividends that we reinvest get bought, they buy at cheaper prices. And so you get more shares. And so that's part of our long-term growth.
Yeah. Yeah, and as long as you're allocated in the right places and the right way, it can work very well. But you've got to review these things on a regular basis. You folks have heard me say this. So internally here we have two investment committee meetings a week, Tuesdays and Fridays, for different purposes each one. But and that's one of the best things that Thomas and his team brought to our process is that consistent meeting and discussing our investments for sure. Certainly their research and their analyses and recommendations and implementation and all the good things that they do for us. But that doesn't mean that we're capricious with our investments. We don't make changes unless we need to make changes. But there's no moss that grows on these things, and we're always talking about, well, let's look at this. We just did a whole review of mutual fund trading costs, right? We had that whole discussion, not to name names, but we do have a question, and that was great presentation. Thank you, Thomas. We do have a question from Keith. Keith writes, "What about possible changes to realize long-term capital gains taxes?" So I'll take that, and Thomas, you can weigh in if you'd like. I think it's pretty obvious that capital gains tax is likely to be the first focus of any tax increase. Any increase in marginal tax rates, the earned income tax, anything that is taxed as ordinary income, whether you earn it yourself or distributions from retirement accounts, et cetera, are going to be seen as tax increases across the board, and mostly to the middle class. Capital gains tax seems to be thought of as tax on the wealthy only. Now, we all know that that's not the case. There's plenty of people out there that have capital gains tax on things. You have some exclusions on housing and whatnot, but whether you make $1 million a year or $50,000 a year, if you have an investment and you sell it, you realize capital gains. But and there are some income exclusions, but you got to remember, this is important, that your capital gain, it'll affect your income restrictions anyway. Okay, so I'm going too far into it, but what's likely is that that will be the first focus, is the increase in capital gains tax. So we've seen recommendations that came out of the White House in March. There was a proposal to raise the highest capital gains rate from 23.8, where it is today, to 44.6. That's a big jump. So that was for anybody who had income over $1 million, but that is, that you can do that if you sell a business, sell a property, something like that, or rebalance a large stock position or stock positions. There's been discussion. So I don't think that's going anywhere. That was Biden's proposal, and obviously Biden's, we know, isn't going to be our president. The other discussion is, I've been hearing 32 to 35%, which is still a significant increase. And so, Keith, I think we're going to see an increase in long-term capital gains. I think that's going to be one of the first things we see. I think we're probably safe for 2025, but just under the Tax Cuts and Jobs Act, I don't think we're going to see movement before that tax code expires, our current tax code. But I think that's going to be one of the first things we see in 2026, depending on who wins the presidency and who wins Congress. Thomas, this was excellent information as always. Folks, I have to tell you, when I ask Thomas investment related questions, I always get very thoughtful and very well supported research and advice. And I just like you saw today, it's not, I don't just get platitudes or simple answers. I get, okay, here's what I think we should do. And here's the data that supports it. And that's obviously played out in the success in our portfolios. And Thomas is right. When I do reviews with clients and everything's a positive across the board in every account. No matter what the investment, I have to say we cannot expect this going forward. This snapshot in time, everything looks really great, and we should applaud and be really happy. But there are times when the market drops, and we can get complacent, and we can just think that this is the expectation going forward. But we've got a lot of volatility ahead, and there's a lot of good reasons why that volatility will be here. Thomas talked about a lot of them, but Thomas, I want to thank you as always. We'll do this again. I don't know if we'll do it before the end of the year, but we'll look at a time going into the beginning of the year. We will do a client-only webinar where we can dig into some more specifics about what we're doing, where we talk about individual securities we're holding. We do a lot of really neat things within our portfolios that again, most people just aren't doing. And we do a lot of that, obviously, with all of it with the help of Thomas and his team. But thank you, everybody. I hope this was helpful. I look forward to seeing you all next week at our next webinar. And if you wanted to reach out to us, and if you have any questions, you can reach out to us at questions@attleborowealth.com. That's questions@attleborowealth.com. And if you want to schedule a 15 minutes introductory call or discovery call with me, you can do so by clicking in the link in the description of the YouTube channel. Or if you're listening to this on the podcast, there's also a link in the podcast description. Thanks, everybody, and have a great week. Take care.